I've said many times before in my past videos that oil is what makes the world go round. It is the exploitation of this precious liquid fuel in the 20th century that has been responsible for high growth rates in the economy and our high standard of living. If the rates of oil production decline, then it will have a negative impact on our standard of living and will implode our credit-based economic system. Simple as that. Here is a high-level overview of conventional oil flows between three broad classifications of users and producers. I assume about $100 per barrel in this diagram because it is roughly representative of recent average pricing. We have the U.S. with a claimed 31 billion barrels of oil reserves. We have OPEC with a claim of 1,068 billion barrels of oil reserves. And we have the rest of the world with a claimed 284 billion barrels of reserves. Each one of these users/producers produce some oil for the domestic consumption and either export or import oil. The U.S. consumes about 6.7 billion barrels per year, which is far higher than domestic production, making it necessary for the U.S. to import 4.9 billion barrels per year of conventional oil. It has been advertised, mainly by special interests attempting to attract investment dollars, that the shale oil boom will change this and make the U.S. a net exporter. As a chemical engineer that has looked at this closely, I will tell you right now that I'm a little skeptical that this is anything but a very short-term solution. But the future of shale oil isn't really the point of this video, and so let's put that topic on the back burner for now. The rest of the world, aside from OPEC, also consumes more than they produce, leaving them with a deficit of about 4.9 billion barrels per year. And so, OPEC, with their vast oil reserves, exports a total of about 7.1 billion barrels of oil every year to supply the U.S. and the rest of the world. This is a very large amount of oil and has been responsible for the OPEC nations becoming very wealthy over time. OPEC has needed to find ways to deploy the money that pours in from their oil revenues. Some of it is spent on domestic consumption, but much of it is invested. OPEC has set up many sovereign wealth funds to deal with the money inflows and invest it wisely. For more information, please watch my older videos, The Flow of Gold and Oil and Gold and the Petrodollar. OPEC has a keen interest in gold, not dollars, as has been the understanding between the U.S. and Saudi Arabia from well before OPEC was founded, and as evidenced by threats of some of the OPEC nations that they will start taking gold in exchange for oil instead of dollars. The threat of taking gold for dollars is a very interesting one. Let's explore that a bit and think through what might happen if oil bid for gold directly. But first, let's take another look at how OPEC gets the gold it is interested in. At $100 per barrel, OPEC will have roughly $710 billion per year to figure out what to do with. So what do they do? Well, as I stated, part of this money is used to invest in infrastructure, part of this money is used to buy conventional investments, but quite a bit of this money is also used to secure real physical gold. The amount of money used for investment and how it is deployed is a tightly kept secret by the sovereign wealth funds. But let's acknowledge that each year, up to $710 billion may be available for the purposes of obtaining real physical gold. In a minute, we'll discuss what might happen if they try to buy physical gold directly, but let's discuss the better option, which is to provide investment capital to mining firms through the bullion banks. So here's roughly how it works. Mines need money now to fund their mining operations, but investments in new mines can only produce metal in future years, many years to come. OPEC provides investment capital to the bullion banks, who provide futures contracts to OPEC in return that allow them to gradually draw the physical metal that they desire. The supply of real gold is guaranteed by monetary authorities via gold loans to the bullion banks. The monetary authorities are not shown here. The bullion banks supply funding to the mining companies in return for collateral and contracts to supply future gold back to the bullion banks. About 0.08 billion ounces of gold are mined each year globally. Much of this gold is supplied to the market via other means, but quite a lot of it is used to close out the hedges, in other words, the futures contracts. And so we see that up to $710 billion might be used to secure a flow of gold of up to 0.08 billion ounces per year. The $710 billion number and the 0.08 billion ounce number are not precise. They are only limits showing the rough order of magnitude of the numbers that we're dealing with. Now, the big advantage of going through the bullion banks, who can be the liaison with Western money authorities and the gold mines, is that nobody is bidding directly in size for the current above-ground stocks of gold, which are very tightly held, which I will explain further in another video. Instead, the bids are for future mine production. This future gold is not tightly held. In fact, the mining company executives are only interested in making dollar profits, and so if an arrangement appears profitable on paper, the executives will be more than happy to make the deal. And thus, gold can be obtained much more cheaply than it ever could if such a large amount of wealth were to bid for physical gold directly. This is a very important thing to note. Gold, at its current indicated price, is too small for big money to hide in. These low prices can only be taken advantage of by small investors. I'll say this one more time because it is so important. Gold, at its currently indicated price, is too small for big money to hide in. These low prices can only be taken advantage of by small investors. Let's consider what would happen if all of the OPEC oil revenue bid for all of the global mine supply. Simply dividing the oil revenue by global mine production, we can calculate we'd need a gold price of $8,875 per ounce for gold mine supply to be large enough for the oil money to hide in. Funny how close this is to the $88.90 per ounce number that I provided the other day if China were to require gold payment for their net exports, huh? Well, it's just a coincidence, so don't read too much into it. But speaking of the Chinese, the $8,875 per ounce number is if the oil money pays directly for 100% of global mine supply and there is nobody else competing for that gold supply. Think about this for a moment. We know that China is importing at least 1,000 metric tons of gold per year. This is about 0.032 billion ounces of gold, which represents nearly half of what the global mines can supply, and some of those mines are in China. Also, gold that is produced in China or is imported into China will never come out. Well, at least not for now. But back to the question of what would happen if the oil money were to directly bid for gold in the public eye. And so for help with that question, let's take a look at the flash crash in gold on Monday, January the 6th, as illustrated by this chart courtesy of NANEX. This is for the front month contract in gold, which is the February contract. It is about as close to spot as you can get right now on the futures market. What happened that day was that prices were generally steady in the morning with very low volume of trading, at least that was up until 10:14 a.m. Then suddenly an offer was made to sell 4,200 contracts. At 100 ounces per contract, this was the equivalent of making an offer to sell 420,000 ounces of gold. This completely overwhelmed the market and caused the price of this contract to decline by more than $30 per ounce almost instantly. An exchange circuit breaker was tripped, suspending trading momentarily, and shortly after trading resumed, the price rebounded to be within $10 of the starting price before the crash. What is interesting is that the order was only for $523 million worth of gold at current prices, which is just north of $500 million. But OPEC oil wealth is $710 billion per year, which is $1.9 billion per day. If a $500 million sell order for spot gold on the COMEX broke the market, what would 4 times that amount of buy orders in the near month every day do? Well, I think we can conclude that the COMEX market is far too small a sandbox for OPEC to play in. Anywhere even close to 25% of OPEC oil revenues or more would break the COMEX, and that's assuming that nobody else is bidding for the gold. And that's why the oil and the gold deals are handled in the much larger and much more private London market, and are brokered directly by the bullion banks. But the important thing to note here is that the sell order that caused what is now called the flash crash is very tiny compared to the amount of investment capital OPEC has to work with. It is also very small compared to the value of net Chinese exports. COMEX is a price-setting mechanism for small players. Big players do their deals behind the scenes in London. That's where the real action is. And the terms of these deals are not for our eyes to see, and the value that they place on gold is not necessarily the one that we see, because these big players are not public market participants. In other words, the financial giants of the world are using a completely different price discovery mechanism than the rest of us, and they value gold much higher than we do. Gold, at its currently indicated price, is too small for big money to hide in. These low prices can only be taken advantage of by small investors.